Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Monday, May 25th, and we're seeing some notable developments across markets as geopolitical tensions ease and investors digest what's been a turbulent period for risk assets. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story this morning is the easing of geopolitical tensions, particularly around Iran. We're hearing from General Petraeus that Iran is in the process of blinking over the Strait of Hormuz situation, and Trump is preparing to announce what he's calling a negotiated Iran deal. This is having immediate market effects, with oil prices tumbling significantly. The energy market veteran Jeff Curry is warning that we're at tank bottoms in Asia and Europe isn't far behind. This peace progress is driving emerging market assets higher, and we're seeing European bond yields drop as risk appetite improves. On the corporate front, there's substantial activity with Zepto planning a $1 billion India IPO filing in June, and Delivery Hero shares jumping 10% on news that Uber is mulling another takeover bid. We're also seeing Jardines making a $2.4 billion Australian radiology deal, which signals a strategic pivot for them. What's particularly interesting is the contrast between the equity strength and the underlying concerns about competitive pressures, with companies like Dexcom facing headwinds in 2026 and Huawei planning new smartphone chips this fall to compete with Nvidia and Apple.
That Iran development is certainly a major shift. How are you reading the market's interpretation of this news, particularly in terms of sector rotation?
The market is clearly pricing in a risk-on scenario here. We're seeing European stocks at their highest levels since March 2nd, and India's Nifty 50 was up 1.32% at close. The Wall Street Journal is reporting that investors just can't get enough of stocks these days, which speaks to the strong appetite for equities despite the summer risks ahead. What's important to note is that this isn't just blind optimism. Stocks are riding what MarketWatch calls an earnings hot streak, so there's fundamental support here. However, the energy sector is taking a hit with oil prices falling on the Iran deal prospects, even though Trump says there's no rush. We're seeing a clear rotation out of energy and into sectors that benefit from lower oil prices and reduced geopolitical risk. The bond market is also telling us something important, with yields dropping in Europe as investors price in less inflation pressure from energy costs. This creates an interesting dynamic where we might see multiple expansion in equities if the peace deal holds and inflation concerns ease further.
Speaking of the indices, what's your technical read on where we stand with the major benchmarks?
Looking at the technicals, the S&P 100 is showing solid strength above key support levels, and we're seeing good momentum as the geopolitical risk premium gets unwound. The index is trading in a constructive pattern with higher lows, and if we can hold above the recent consolidation zone, there's room to test the March highs. The Nasdaq is particularly interesting because it's being supported by the big tech bond market dominance that the Financial Times is highlighting. We're seeing technology continue to lead, and the Nasdaq's technical setup suggests we could see a breakout if the risk-on sentiment continues. The Dow is benefiting from the broader market strength, but it's lagging slightly compared to the tech-heavy indices, which makes sense given the sector rotation dynamics. What I'm watching closely is whether we can sustain these levels through the economic data releases coming this week. The key resistance levels to watch are the prior swing highs from early March, and if we break through those with volume, it could signal a more sustained rally into summer.
That's helpful context on the technical picture. What does all this mean for traders looking at opportunities this week?
For traders, the key is to recognise that we're in a news-driven environment where geopolitical developments can shift sentiment quickly. The immediate opportunity is in sectors that benefit from lower oil prices, particularly airlines, transportation, and consumer discretionary stocks that see margin improvement when energy costs fall. On the flip side, energy stocks are under pressure, and I'd be cautious about trying to catch a falling knife there until we get more clarity on the Iran deal. The IPO market, heating up with names like Zepto, is another signal that risk appetite is strong, and that typically creates opportunities in growth-oriented sectors. However, traders need to be mindful of the competitive dynamics we're seeing, with established players like Dexcom facing new challenges. The corporate M&A activity, with Uber potentially bidding for Delivery Hero and Jardines making strategic acquisitions, suggests that quality assets are getting attention, so looking for potential takeover targets in consolidating industries could be worthwhile. I'd also keep an eye on the bond market, because if yields continue falling, it makes equities more attractive on a relative basis, which could fuel further inflows into stocks.
Now, let's turn to the crypto markets. Lizzie, what are you seeing in terms of trends for Bitcoin, Ethereum, and Solana heading into next week?
The crypto market is facing significant headwinds right now. Robert, Bitcoin is showing a bearish to neutral sentiment as we head into next week. The big story is the brutal 6-day loss streak in Bitcoin ETFs, with $2.26 billion in outflows over the past 2 weeks. That's creating real selling pressure, and we're seeing Bitcoin trading in the $74,000 to $77,000 range. Multiple analysts are forecasting potential downside to the $60,000 level, which would revisit the 2026 lows. However, there are some contrarian signals emerging. The 1.26 billion in ETF outflows is actually sparking what Sentiment calls a contrarian buy signal. And there's a new report suggesting a massive $1 trillion hidden institutional market waiting to be unlocked in Bitcoin. The positive development is the SEC approving Nasdaq to list Bitcoin index options, which is solid long-term infrastructure building. For next week, I'm expecting Bitcoin to trade with a bearish bias, likely in the 70,000–75,000 range, with key catalysts being the PCE inflation and GDP data releases. Ethereum is in worse shape, frankly, with a clearly bearish outlook. Tom Lee's Ethereum portfolio is down $7.35 billion, and there's growing criticism around the Ethereum Foundation's effectiveness. Vitalik Buterin is defending the foundation and promising reduced ETH selling under what he calls a leaner plan. But the technical pattern shows a bearish rounded top forming that suggests potential for further downside. Bank of America chose Bitcoin ETF over Ethereum in Q1, which tells you where institutional preference is heading. Solana is also showing bearish signals, with analysts warning of potential drops below $80 as a risky technical pattern emerges. The concerning part is that Solana is getting less media coverage compared to Bitcoin and Ethereum, which suggests reduced market interest overall.
What about the institutional versus retail dynamic in Bitcoin right now?
That's where it gets really interesting. On the institutional side, we're seeing mixed signals. The heavy ETF outflows suggest institutions are reducing exposure, and the fact that Strategy, formerly MicroStrategy, is buying bonds instead of Bitcoin. This week is notable. Michael Saylor himself said it's not unlikely that Strategy will sell Bitcoin in 2026, which is a significant shift in tone from the company that's been the poster child for corporate Bitcoin accumulation. Bank of America picking Bitcoin ETF over Ethereum, and Solana shows they're still in the space but being selective. However, there's this hidden institutional market that the new report talks about, suggesting that not all institutional activity is visible in the ETF flows. On the retail side, we're seeing some concerning signs. Binance inflows jumped 3 times in just 10 days, which can be a sell signal because it often means retail is moving coins to exchanges to sell dormant whale movements, with 2650 BTC transferred to major trading firms also suggests distribution rather than accumulation. The retail investor is also showing preference for hype funds, which are attracting millions as investors dump Bitcoin and Ether ETFs. So the overall picture is one of institutional caution and retail rotation, which creates a bearish near-term setup. However, the infrastructure developments like Nasdaq options approval are building the foundation for institutional participation long-term. So this could be a period where patient investors find opportunities if we do see that drop to 60,000 that analysts are forecasting.
That wraps up today's Morning Bell. We've covered the easing geopolitical tensions driving market sentiment, the technical setup across major indices, and the challenging environment in crypto markets as institutional flows turn negative. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market analysis. I'm Robert, thanks to Lizzie and Steve, and we'll see you tomorrow.